Good morning. Thank you so much for inviting me. A special thanks to Bengal Economic Association and Professor Subhrato Ray for inviting me for this conference. And it's wonderful to be in the panel with Professor Abhirup Sarkar and Professor Bishudit Chatterjee. This Union Budget 2022 was presented in the Parliament prior to the mounting geopolitical risk of war in Ukraine, and how these global macroeconomic uncertainty impact the fiscal arithmetic in India that depends on the fiscal monetary policy interface to respond to the crisis. And the recent Omicron wave is also a reminder that ever mutating coronavirus would continue as a determinant of macroeconomic uncertainties. And globally, several central banks have begun monetary policy normalization by reducing their balance sheets, by ending asset purchases, and also through an earlier than expected hikes in the policy rates. And the financial markets in the emerging economies have turned volatile, indicating strong capital flight with mounting uncertainty on the potential rate hikes by the US Fed Reserve. RBI of India, in the Monetary Policy Committee MPC deliberations during February 8 to 10, 2022, has delayed the normalization procedure by maintaining a status quo policy rate at 4% as they focus on growth recovery process first. However, when inflation is rising, a slow policy tightening by the central bank could accelerate the de-anchoring of inflation expectations, further, deepening stagnation. And given these mounting pressures on inflation, if central banks bite the bullet and become hawkish by hiking the interest rates, then growth recovery process will be severely dampened. Given these constraints or the policy dilemma on the monetary policy stance, can we rely on fiscal dominance to counter the adverse impacts on growth recovery of exogenous supply shocks? Globally, fiscal authorities have increasingly accommodated high fiscal deficits to support growth recovery, and servicing these debts will become much more expensive if there is hike in interest rates. And there is an increasing recognition for accommodative fiscal space in the times of pandemic crisis. The efficacy of fiscal rules, whether you adhere to numerical threshold ratios of deficit, whether that is growth enhancing, needs a recalibration in the times of pandemic. If the path to fiscal consolidation is through revenue compression than increased tax buoyancy, then the quality of fiscal consolidation gets affected. High fiscal deficit has got no fiscal cost. That's what, eminent macro scholar Olivier Blanchard has substantiated. And he mentioned that if it is with increased public investment or reducing the output gap, then high debt has no fiscal cost. And climate change risk further aggravate the macroeconomic uncertainties. And how well monetary policy stance can incorporate such risk and uncertainties within the available toolkit, that is questioned by many macroeconomists. And there is a broad consensus among the economists that fiscal policy is capable to deal with the climate crisis, and national budgets have become an important tool to address these climate change commitments. And Union Budget 2022 announced green bonds for the first time ever in the context of India. And regarding the global uncertainties, the International Monetary Fund, IMF, revised global output and trade growth projections for 2022 downward to 4.4% and 6% from its earlier forecast of 4.9% and 6.7% respectively in its January 2022 update of World Economic Outlook. These revisions in growth projections and the trade growth projections is due to the hardening of commodity prices and mounting inflationary pressures. The war in Ukraine will accentuate this global stagnationary recession when inflationary expectations are becoming unanchored, and the massive negative supply shock in the growth economy will reduce growth further. The volatility in energy prices, the spike in oil prices to well above $100 per barrel, along with the hardening of global commodity prices, will add to these uncertainties. And a deep stagflationary shock is also a nightmare scenario for the central banks, and which will be damned if they react and damned if they don't react. So that's a policy uncertainty with relate to monetary policy stance. So against this backdrop of mounting macroeconomic uncertainties, the real growth rate for 2022-23 is projected by the Monetary Policy Committee at 7.8%, with the quarter 1 2022-23 at 17.2%, and quarter 2 at 7%, quarter 3 at 4.3%, and quarter 4 2022-23 at 4.5%. So this is what we got the deliberations from the MPC committee minutes. The 33rd meeting of this MPC, the Monetary Policy Committee, constituted under the Section 45(b) of Reserve Bank of India Act 1934, was held from February 8 to 10, 2022. And in that meeting, MPC retained the status quo on repo rate at 4%. The reverse repo rate under Liquidity Adjustment Facility (LF) also maintained its status quo rate of 3.35%, and there is no formal normalization procedure yet, though there is a cutoff yield rate for variable repo rate. Reverse repo rate VRRR has risen to 3.99%. The standing committee, the marginal standing facility MSF rate and the bank rate stood at 4.25%. And the MPC has decided to retain the accommodative stance to revive economic growth on a sustained manner and mitigate the impact of COVID-19 on the macroeconomy. And these decisions are in consonance with the objective of achieving the medium-term target for consumer price index based inflation of 4% within a band of plus or minus 2% while supporting the growth momentum. The normalization procedure for monetary policy stance is crucial for the effective functioning of the term structure of interest rate. The term structure of interest rate refers to the link between short-term and the long-term rates of interest. For instance, the call money market rates are below the repo rate in India. As per the RBI published data on March 4th, 2022, the weighted average call money market is 3.530%, and the treasury bill cutoff price for 91 days is 3.7%. The treasury bill cutoff price for 182 days is 4.19, and the treasury bills cutoff price for 364 days is 4.52%. This data is as per March 4th, 2022. And on the long-term rate of interest, the average yield on 10-year government bond that increased from 6.76% in March 4th, 2022. There is mounting pressure on RBI to increase the policy rates due to inflationary pressures and the instability in global financial markets due to impending taper tantrums and the plausible rise in interest rates by US Federal Reserve. This can trigger capital flight. In India, foreign exchange reserves increased by $55 billion in 2021-22 up to February 4th, 2022 to $632 billion. And correspondingly, if you look at the reserve money that is adjusted for the first round impact of the change in the cash reserve ratio, the reserve money expanded by 8.4%, that is YOY estimates as per February 4th, 2022. in February 2022, the growth rate of the reserve money in India was 13.7%. The net foreign exchange reserve that constitutes 66.8% of the major, that's a 66.80 of the reserve money. Okay, and the other components of the reserve money are net RBI credit to the government, which is otherwise the monetized deficit, that is around 34%. And the government's currency liabilities with public, that is as significant as 0.22%. The net in, the RBI credit to the government to GDP, that's otherwise called the monetized deficit. This net RBI credit to the government to GDP, that ratio is also termed as seigniorage. In India, over the years, the seigniorage financing of deficit has been controlled due to inflationary pressures. And the levels of financing of deficit in India against a backdrop of Union Budget 22, that's very important to look into. While monetary policy has limitations to trigger the economy, fiscal dominance is crucial for economic growth recovery. The Union Budget 2022-23 has predominantly focused on the public infrastructure investment for sustained growth recovery through crowding in of private corporate investment. And the taxonomy of crowding out into real and financial, that has been treated in detail if you look into my book, published by Sage, titled Fiscal Consolidation, Budget Deficit and Macroeconomy. In that book, I have given the taxonomy of crowding out, and I looked into the empirical evidence of any crowding out in the context of India. Students can take a look into my book, chapter 2. The real or the direct crowding out occurs when the increase in public investment displaces private corporate formation broadly on a dollar for dollar basis, irrespective of the mode of financing of fiscal deficit. And the financial crowding out is a phenomenon of partial loss of private capital formation due to increase in the interest rates emanating from the preemption of real and financial resources by the government through bond financing of fiscal deficit. And in India, the Finance Minister Srimati Nirmala Sitharaman, from a position of strength, refuted this neoclassical argument of crowding out, and she emphasized the significance of crowding in effects of private investment through public investment or capital formation. Especially this is true in the context of emerging countries like India. It is crowding in rather than crowding out. And empirical evidence also supports in India that it is crowding in rather than crowding out. If you take a look into my paper with, Rishikesh Vinod, the famous econometrician of Fordham University, New York, and, Karan of, IMF, we have written a paper, and that paper is included in the handbook of statistics published, and that is edited by the famous econometrician C.R. Rao and Professor Rishikesh Vinod. And you can take a look into that volume on the handbook of statistics, where we are focusing on R. In that we used MEBOT, that is a maximum entropy ensembles methodology, to capture the impact of public investment on the private investment. And students may be interested in looking into this MEBOT as an econometric methodology, especially when your time series are short. So it's a perennial problem in econometrics, and if your order of integration, when you look into the pre-test, for the stationarity test, and if it is I0 and I1, and if it is integrated of a different order, then you may get into trouble when you go for models. So two methodologies are there to tackle this. One is, of course, Todo Yamamoto. You can take a look into that econometric paper to deal with your variables if they are, integrated of different order. Otherwise, of course, there is ARDL procedure and this maximum entropy ensembles, if your time series short and if you have problems of the mix of the order of integration of variables, you can use this maximum entropy ensembles. Like it's like if you have a short run, they create ensembles. It's like reincarnations of the variable, and the confidence interval will be different, and that new beta you get from this reincarnations or these ensembles of broadening that short time series, that beta you need to check in within the confidence intervals whether it is significant or not. And it's an interesting methodology. Students can take a look into that methodology of maximum entropy ensembles bootstrapping. And now this mechanism through which the public investment crowds in private investment is through the multipliers related to capital infrastructure. And Union Budget 22-23 has given emphasis to this narrative. In Union Budget 22-23, government has increased the capital spending to a record high of 2.9% of GDP. However, fiscal deficit to GDP is 6.9% in 21-22 revised estimates as compared to the pegged 6.8% in the 21-22 budget estimates. So there is a slight fiscal slippage when you look into the fiscal deficit numbers from 6.8 to 6.9. But it's much better than the fiscal deficit GDP ratio, which was 9.2% in 2020-21 actuals. High fiscal deficit GDP ratio was 9.5% in the revised estimates of 21-22 as against the pegged 3.5% in 21-22 BE. That is, of course, it is announced, or this hike is announced against the backdrop of the macroeconomic uncertainty due to the COVID-19 pandemic. And the excessive deficit procedure roadmap has also been announced to bring down the fiscal deficit to GDP ratio to 4.5% by the financial year 25-26. The revenue deficit GDP ratio is 3.8% in 2022-23 budget estimates as against 4.7% in the previous year, that is 21-22 revised estimates. In 2020-21 actuals, for a comparative say, if you look into the revenue deficit to GDP ratio was 7.3%. In the times of pandemic, high revenue deficit is crucial for macroeconomic recovery. And so the golden rule of fiscal responsibility and budget management, that is to phase out the revenue deficit, is, a little bit invalid in the times of pandemic, because it affects the growth recovery process if you curtail or if you go for an expenditure compression of the revenue spending. And this rule of the golden rule of, revenue receipts equal to revenue expenditure, or to phase out the revenue deficit, that rule was eliminated in 2018 Amendment Act of the FRBM, and the clauses related to this is included. It was included in the financial bill of 2018. Students can take a look into that. And making revenue deficit to zero in the time of pandemic is not feasible, because compression in the revenue spending can affect the growth recovery process. But I need to tell you a very critical ratio, that is revenue deficit to fiscal deficit ratio. And that is 59.61% in 22-23 budget estimates. But if you look at the earlier years, it was 79.72% in 21-22, and it has come down. But that ratio of revenue deficit as a part of fiscal deficit is as high as around 60%. That's a matter of concern if the interest payments to revenue receipts is higher. Okay, because and then what you earn through the revenue receipts, that's going a predominant chunk or the predominant portion of your revenue receipts is going to finance the interest payments. So that's why you need to take a look into that interest payments to revenue receipts ratio as well. Now, primary deficit, that's a difference between fiscal deficit and interest payments. It is pegged at 2.8% of GDP in 22-23 budget estimates. The primary deficit to GDP has reduced from 5.8% in 21-22 to 3.3% in 21-22 revised estimates. And the primary deficit reflects the current fiscal policy stance of the government. That is, without the legacy of the past interest liabilities. Union Budget 22-23 needs to be co-read with the FRBM Act, the fiscal rules, which includes the statements of macroeconomic framework and the medium-term fiscal policy strategy to reduce the current general government debt to GDP of 90.6%. So the efficacy of cyclically neutral fiscal deficit needs to be treated with caution, because if the fall in GDP is a permanent drop or a permanent scar from the trend growth rather than a transient deviation, it is incorrect to assume that an upturn in the business cycle can eliminate the cyclical part of deficit. So the fiscal rules at the state level has been revised. Now, the borrowing limit for the state is 4% rather than 3% of GDP in the revised state's FRBM, that commitment in the context of pandemic, but 0.5% of the increased 4% is the efficiency-related parameter to power sector reforms. So in addition to this, a capital outlay of 1 lakh crore is transferred to the states for strengthening the infrastructure development through state highways and Pradhan Mantri Gram Sadak Yojana and related capital projects. This focus on infrastructure projects to the states is against the backdrop of the state elections. However, Union Budget 22-23 has not engaged in populist policy announcements to incentivize the calculus of consent of the voters in these 5 states, against the backdrop of the elections. A threshold ratio of debt and deficit and the fiscal rules might prove detrimental in the time of pandemic, as it constrains the fiscal space. High public debt has no fiscal cost if the real rate of interest, R, is not greater than the real growth of economy, G. Okay, in the Union Budget 2022-23 budget estimates, the fiscal deficit to GDP ratio is pegged to be 6.4%. In the last Union Budget, budget transparency was given emphasis by incorporating a portion of off-budget borrowings, OBB. For instance, the Food Corporation of India's borrowings from the Small Savings Fund was stopped. Therefore, the fiscal deficit of 9.2% of GDP in 2021-22 was inclusive of budgetary transparency as well, along with the new expenditure priorities. And the sources of financing of deficit show that there is a deviation between the budget estimates and the revised estimates for the gross market borrowing in 2021-22 from 74,000 crores to 8,75,000 crores. Now, in the Union Budget 22-23, the gross market borrowings was around 69.75% of the total debt. And of course, there is a deviation between the budget estimates and the revised estimates for the securities against the small savings. And, in that financing pattern, you can see the small savings, which constitute 25.61% of the total debt. There's a slight increase in the securities against the small savings and a slight decrease in the gross market borrowings, if you look into the BE and RE, and that's very interesting, that why securities against small savings is on rise, and the gross market borrowing, if you look into the BE and RE, it's a slight decrease that's marked. The deficit through off-budget borrowings through public sector enterprises is not the part of fiscal deficit. This can be captured better through the construction of public sector borrowing requirement data. The coverage of the PSBR is a general government deficit plus the borrowing through the public sector enterprises. However, India has not yet constructed a time series on PSBR. In the Union Budget 22-23, in the revenue account, the revised estimates was higher than the budget estimates in the 21-22 Union Budget, that's last year's, for both tax and non-tax. Then tax and non-tax revenue was buoyant. If you look into the growth rate of tax when compared to the growth rate of GDP, of course, the growth rate of tax was higher than the growth rate of GDP. That's why the taxes are buoyant and you get the tax buoyancy that is above 1%. Okay, and the non-debt creating capital receipts was a matter of concern, particularly the disinvestment or the privatization proceeds. That showed a huge fiscal slippage. With the disinvestment target of 1.75 lakh crore, the government has received only 78,000 crores in 21-22. In 2021, the proceeds from disinvestment was 37,000 crores against the target, that ambitious target of 2.1 lakh crores. So, in 22-23 budget, Union Budget, it is very realistic. The targets on, disinvestment proceeds. Government has provided a very conservative estimate targeting only 65,000 crores in this current Union Budget. So, that's a target. It's very conservative, that estimates. The public expenditure is pegged at 39 lakh crore in 22-23. Of course, that is higher than 21-22 revised estimates, that is around 37 lakh crore. And revenue and capital expenditure, of course, constitutes around 81 and 19% of the total expenditure. That is, revenue spending is around 81% and capital spending is around 19%. And the effective capital spending, that includes the grants in revenue or the grants in aid for the capital assets that is happening from the revenue expenditure budget. So a portion of revenue expenditure is capital creating in nature. So if you add to that, the capital spending, then you get the effective capital expenditure. Over the years, if you look into the numbers, the effective capital expenditure has increased from 6 lakh crore in 2020-21 actuals to around 8 lakh crore in 21-22 revised estimates, and now the effective effective capital expenditure, if you look at it, is pegged at 10 lakh crores. That's in 22-23 budget estimates. And there's a huge deviation between revised estimates and the budget estimates in both revenue expenditure and capital expenditure for the year 21-22. The fiscal slippage in the revenues expenditure in 21-22 was from 29 lakh crore in the budget estimates to 31 lakh crore in the revised estimates. And the revenue and the capital expenditure are pegged at a very high amount in 22-23 BE than in 21-22 RE. So the interest payments, if you look at as a percentage of revenue receipts, which I mentioned earlier, it's as high as 42% or 42.67% if you look into the numbers of 22-23 budget estimates, and that pegging is a matter of concern. It's interest payments as a percentage of revenue receipts. As high as 42.67% of your revenue receipts is going for interest payments. Of course, that's a matter of concern, but, there is an increasing recognition of the fact that public investment also has suffered from fiscal consolidation when the national and subnational governments have over-adjusted to the fiscal rules by capital expenditure compression. And the emphasis on the public infrastructure investment in the Union Budget 22-23, that's crucial for strengthening gross capital formation. And it is especially when the credit infusion, the predominant component of economic stimulus package, has its limited impact. The credit infusion in the economy has been the predominant narrative of pandemic economic stimulus programs in India. RBI has done a heavy lifting to support the economic growth recovery through liquidity infusion strategies. And the Operation Twist, that's a simultaneous buying, that's a long term, and simultaneous selling of short term bonds, has led to the elongation of maturity structure of bond markets by postponing the refinancing risk to engage in economic growth revival process. The RBI has also engaged in targeted repo operations to provide liquidity to the stress sectors of the economy. Has the credit infusion into the economy has been effective strategy for economic recovery? Take a look into the work by the Nobel laureate Joseph Stiglitz and Rashid, their 2020 paper. They highlighted in their paper titled "Which Economic Stimulus Works?" that the credit-related economic stimulus has limited multiplier effects. And they also caution that credit infusion might also lead to mounting non-performing assets if there is no corresponding growth of credit in the economy. The data on credit deployment, if you look into the numbers for the month of 2022, it was published by RBI, that is collected from 39 scheduled commercial banks that account for about 92% of the non-food credit deployed by all the scheduled commercial banks. So the 92% of the scheduled commercial banks data, that is what we are going to look into. It's based on 39 scheduled commercial banks, okay? And this data is as per February 28th, 2022. And the data showed that non-food bank credit growth stood at 8.3% in January 2022 as compared to only just 5.9% in January 2021 on a year-on-year basis. And let's look into the credit deployment, sectoral credit deployment. The composition of outstanding credit that showed that credit deployment to agriculture was just 12.4% of the total, and it was relatively smaller than the credit infusion to industrial sector, which was 26.3%, and service sector, the credit deployment was just 25.1%, and this is as per the outstanding credit figures in January 2022. And the large industries, they received 20.4% of the total credit deployment, while micro industries and medium industries received 4% and just 1.9% respectively. Like micro enterprises, they received 4% of the total credit deployment, and medium industries received 1.9% of the total credit deployment. So this uneven access to the credit within the industrial sector is a matter of concern. Now, the personal loans, that is also another important component of the credit deployment. Personal loans constitute 27.5% of the total credit deployment, and within that, housing loan was an important component, and 13.4% of the total credit deployment was for housing loans. And this non-food credit at the aggregate level constitutes 99.3% of the total credit deployment. So what's a broad inference from the credit deployment statistics from RBI? That's uneven access to credit. When large industries access credit significantly higher than small and medium-term industries. And credit growth to agriculture and allied activities grew to 10.4% in January 2022 as compared to 8.5% in January 2021. And credit to industry, if you look at the growth rate, it improved from 6.4% in January 2022 from just 0.7% in January 2021. Now, the credit growth to the service sector registered 7.3% in January 2022 to when compared to 8.1% in January 21. Excuse me. Within the service sector, the credit growth registered in the NBFCs, in transport operators, tourism, hotels and restaurants, these are contact intensive sectors, that registered a little bit of growth, but it is not satisfactory. And within the personal loans, the robust growth rate by 11.66 is noted in January 2022 from 8.7% in January 2021. Now, the priority lending, that is given as a memo in credit deployment statistics. And of course, this credit lending, the priority lending, that constitutes around 40%. Okay, that's a proportion, that is 40% of the entire credit deployment was for the priority sector lending. And within this priority sector lending, agriculture and allied activities that received around 11.7% of the entire tax deployment. Micro and small enterprises within that priority sector lending, that was around 10.7, and this 10.7 is as the percentage of the total credit deployment. And housing within that, again 4.2, then little bit on educational loans, that is only 0.4%. Then export credit around 0.3%. So if you look into the total credit deployment statistics, the export credit, social infrastructure, renewable energy, these are insignificant, share they received. And for the weaker sections, they received around 7.6% for the small farmers and the medium, that marginal farmers, that is 7.6%. Now, take a look into the financial stability report published by RBI in December 2021. The financial stability report showed that macro stress test for the credit risk indicate that the gross non-performing asset, that is GNPA, ratio of the scheduled commercial banks that may increase from 6.9% in September 2021 to 8.1% by September 2022 under the baseline scenario, and to 9.5% under a severe stress scenario. The report further clarified that the scheduled commercial banks would have sufficient capital both at the aggregate and the individual levels, even under the stress conditions, if you compare it with the Basel norms of the capital adequacy ratio. Now, the capital to risk weighted assets ratio, that is CRAR, of the scheduled commercial banks, they rose to a new peak of 16.6% in September 2021. And as per the Basel III stipulated norm for the capital to risk weighted assets ratio is at 8%. And what exactly is CRAR, the capital adequacy ratio? That is banks' capital weighted by the risk weighted assets. Now, the provisioning coverage ratio, what exactly is that? It's a percentage of funds that a bank should set aside for the losses due to the bad debts. That was 68.1% in September 2021. So there is a concern in terms of financial stability. Now, my final point is on the climate change. Is it more fiscal than monetary? In Union Budget 2022-23, Green Bond was announced. That reflects India's commitment to decarbonization against the backdrop of Glasgow deliberations. Green Bond, what exactly is that? It is an onshore rupee-denominated sovereign bond. Green bond is a debt instrument to strengthen green infrastructure projects. And the sovereign green bonds will be the part of government's gross market borrowing. That's for the year 22-23. And integrating climate change criterion in the fiscal policy in India, it has not begun with the green bonds that's announced this year. India was the first ever country to integrate climate change criterion in the intergovernmental fiscal transfers. That happened in 2014. And green bond is of course a policy strategy to finance just transition towards sustainable climate resilient economy. The 14th Finance Commission was the first ever in the world to integrate the climate change criteria in the intergovernmental fiscal transfers. This was then the 14th Finance Commission integrated climate change as one of the criteria to determine the intergovernmental fiscal transfers to 29 states. The 15th Finance Commission has retained the criterion. On the monetary policy front, integrating climate change is a matter of debate. Economists have highlighted that monetary policy does not have sufficient toolkits to integrate climate change criterion. And take a look into the paper by Hansen. In 2021, in the Journal of Monetary Economics, he has written a paper about the efficacy of integrating climate change in the monetary policy framework. He analyzed the ways to examine the toolkits of the central bank policy to combat the climate change related problems and warned that hastily devised policy tools, unsupported by empirically grounded quantitative modeling, could backfire if or when the climate policy targets are missed, harming reputations of the central banks and weakening their ability to act in the future on a variety of fronts, and could compromise central bank independence in the long run. And Hansen also pointed out that climate change mitigation targets added to currently well-defined mandates may generate excessive expectations and unwarranted confidence in the abilities of central banks to address this important social and economic problem while diverting their attention away from fiscal policy. Hansen explained the significance of modeling systemic risk and climate change in support of rules-based fiscal policy for financial stability, and how to quantify the exposure of financial institutions and businesses that receive their loans to uncertain climate change. The climate-focused stress test conducted by the central banks is an upcoming policy tool to address long-term possibilities of climate change and slanting central bank portfolios towards green technologies. Such green stress test is to assess how the banking system is exposed to climate risk and uncertainties. And such test was first conducted by